Welcome to the Finance Wisdom Summaries.
A Random Walk Down Wall Street. Introduction: Understanding the Investment Landscape. Burton G. Malkiel's A Random Walk Down Wall Street challenges conventional wisdom in investing, arguing that predicting short-term stock market movements is futile. Instead, he advocates for a long-term, diversified, and low-cost investment approach. The book navigates through historical speculative bubbles, explores the theories behind stock valuation, and critically assesses the performance of professional investors, ultimately guiding individual investors towards sensible, effective strategies. Chapter 1: Firm Foundations and Castles in the Air. Introduces the concept of a random walk in the stock market, meaning short-term price changes are unpredictable. Distinguishes between investing, long-term profit from predictable income or appreciation, and speculating, seeking overnight riches. Highlights the historical impact of inflation on purchasing power, emphasizing the need for investment strategies that maintain real value. Explores two main theories of asset valuation: the firm foundation theory and the castle in the air theory. Firm foundation theory states that every asset has an intrinsic value, discoverable through careful analysis of its future prospects and present conditions. Castle in the air theory focuses on anticipating crowd psychology and buying assets that others are likely to bid up, regardless of intrinsic value. Key takeaways: the stock market in the short run is highly unpredictable. Trying to time the market or pick individual hot stocks based on short-term predictions is akin to gambling. Inflation is a persistent threat to wealth. Investments must generate returns that outpace inflation to preserve purchasing power. Understanding the difference between intrinsic value and speculative bubbles is crucial to avoid significant losses. Practical example: firm foundation versus castle in the air for a car purchase. Imagine you're buying a car. The firm foundation approach would involve researching its fuel efficiency, maintenance costs, resale value, and safety ratings to determine its true worth to you over its lifespan. The castle in the air approach would be like buying a limited edition car not for its utility, but because you believe social media influencers will hype it up, leading someone else to pay you a much higher price for it next month. Malkiel argues that while the castle might work temporarily, the foundation is the sensible, long-term approach for wealth building. Chapter 2: The Madness of Crowds. Illustrates historical speculative bubbles like the tulip bulb craze in 17th century Holland and the South Sea bubble in 18th century England. It describes how greed and mass psychology lead investors to abandon fundamental valuation for the greater fool theory. It highlights the Florida real estate craze and the 1929 Wall Street crash as modern examples of speculative manias. It emphasizes that predicting market reversals during such crazes is nearly impossible, and most participants suffer significant losses. Key takeaways: crowd psychology can drive asset prices to irrational extremes, creating speculative bubbles. The greater fool theory, buying something overpriced hoping to sell it to an even greater fool, is a dangerous game that inevitably leads to significant losses. Historical speculative binges offer crucial lessons about the dangers of emotional investing and ignoring fundamental value. Practical example: the hype-driven gadget purchase. Imagine a new smartphone is released. Its features are only slightly better than the previous model, but aggressive marketing and online buzz create immense hype. People line up for days, pay double the retail price from scalpers, and boast about their investment. This is akin to the tulip mania or the South Sea bubble, where the actual utility or intrinsic value of the item is secondary to the perceived ability to sell it to an even greater fool to the next excited buyer. Malkiel warns that such hype-driven assets collapse in value. Chapter 3: Stock Valuation from the 60s through the 90s. Examines speculative movements in the stock market from the 1960s to the 1990s, even with increasing institutional dominance.
Details the tronics boom of the early 1960s, where companies with electronics in their names soared regardless of their actual business. Discusses the conglomerate boom of the mid-1960s, driven by synergism and accounting maneuvers to artificially inflate earnings per share. Recounts the Nifty 50 craze of the 1970s, where institutional investors overpaid for one-decision blue-chip growth stocks. Illustrates the biotechnology bubble of the 1980s, where stocks were valued at multiples of sales, not earnings, based on future promises. Highlights the Japanese asset price bubble of the late 1980s and early 1990s, and the internet craze of the late 1990s as recent examples of speculative excesses. Key takeaways. Even professional investors are susceptible to speculative manias, bidding up prices based on the greater fool theory rather than intrinsic value. Novelty and exciting concepts in new industries like electronics, biotech, and internet often lead to irrational valuations and eventual crashes. The market, despite irrational periods, eventually corrects itself, with prices returning closer to fundamental values. Practical example: the App of the Week Startup. Imagine a startup launches a mobile app that promises to revolutionize a niche industry but has no revenue or a clear path to profitability. Early investors caught in the hype push its valuation to billions, focusing on the potential rather than current financial metrics. This mirrors the tronics boom or the biotechnology bubble, where an exciting concept, rather than solid fundamentals, drove irrational price increases. Malkiel advises extreme caution with such new issues and fads.
Chapter 4. The Firm Foundation Theory of Stock Prices. Reiterates the core of the Firm Foundation Theory. A stock's intrinsic value is the present value of its future dividends, or earnings and buybacks. Outlines 4 key determinants of a stock's intrinsic value: expected growth rate of dividends and earnings. Higher and longer-lasting growth increases value. Expected dividend payout. A higher payout generally increases value, ceteris paribus. The degree of risk. Less risky stocks command higher prices. The level of market interest rates. Lower interest rates generally lead to higher stock prices. Introduces 2 crucial caveats to applying the Firm Foundation Theory. Future expectations are inherently uncertain and cannot be proven in the present. Precise figures for intrinsic value cannot be calculated from undetermined data, leading to subjective and manipulable valuations. Key takeaways. While fundamental principles, growth, dividends, risk, interest rates, logically influence stock prices, their exact future values are impossible to predict with precision. Intrinsic value is a fuzzy band rather than a precise number, susceptible to market psychology and individual biases. Investors should use these rules as a general guide to identify grossly overvalued or undervalued assets, rather than as a definitive formula for precise valuation. Practical example: valuing a small business acquisition. Instead of stocks, consider buying a local coffee shop. The Firm Foundation approach would involve estimating its future earnings, how much of those earnings you can take out, dividends, the stability of its customer base, risk, and prevailing interest rates for business loans. However, the caveat is that estimating future coffee consumption trends or unexpected competition, random events, is inherently uncertain, making the precise value of the shop difficult to pinpoint. You might fudge the growth rate in your spreadsheet to justify a higher price if you really want to buy it.
Chapter 5. Technical and Fundamental Analysis. Introduces 2 primary approaches used by investment professionals: technical analysis and fundamental analysis. Technical analysis believes that past stock prices and trading volumes can predict future price movements. Chartists look for patterns like head and shoulders or uptrends to signal buy-sell opportunities. Fundamental analysis seeks to determine a stock's intrinsic value based on factors like future earnings, dividends, and company prospects, independent of past price movements. Highlights the professional disdain for technical analysis on Wall Street despite its colorful methods. presents an example of a fundamental analysis report for Service Corporation International, demonstrating the process of assessing industry and company prospects. Key takeaways. Technical analysis, based on the castle in the air theory, assumes that crowd psychology creates predictable patterns. Fundamental analysis, grounded in the firm foundation theory, aims to find undervalued securities based on underlying business value. Both approaches are widely used by professionals, but their efficacy is subject to debate. Practical example: deciding when to buy a home appliance. Technical analysis. You notice that every time a popular brand of refrigerator goes on sale at a certain discount, its price tends to rise back quickly within a week. You decide to buy as soon as it hits that discount, assuming the pattern will repeat. Fundamental analysis. You research different refrigerator brands, comparing their energy efficiency, warranty, repair history, and features to determine which offers the best long-term value for its price, irregardless of recent sales fluctuations. Malkiel argues that while technical analysis might occasionally seem to work due to chance, fundamental analysis is the more logical long-term approach, even with its inherent uncertainties.
Chapter 6: Technical Analysis and the Random Walk Theory. Challenges the effectiveness of technical analysis, arguing that past stock price movements cannot reliably predict future ones. Explains the random walk concept more formally. Stock prices behave like a random walk, meaning future steps are unpredictable based on past ones. Presents evidence from various studies, e.g., filter systems, Dow theory, relative strength systems, price-volume systems, and chart patterns, showing that technical strategies generally fail to outperform a simple buy-and-hold strategy after accounting for transaction costs. Attributes the persistence of belief in technical analysis to statistical illusion and human nature's desire to find order in random events. Discusses the self-defeating nature of successful technical schemes. Once a profitable pattern is discovered and acted upon, it is likely to disappear. Key takeaways. The weak form of the random walk hypothesis states that past price information is useless for consistently outperforming a buy-and-hold strategy. Extensive research supports this. Technical analysis often generates significant transaction costs which erode any potential gains. Don't be fooled by market gurus or anecdotal success stories. These are often products of chance or misleading data. Practical example: the lottery ticket pattern. Imagine you've been tracking winning lottery numbers and notice a pattern where certain numbers appear more frequently after others. A technical analyst would create a system based on this pattern. However, each lottery draw is an independent random event, and past results don't influence future ones. Any perceived pattern is a statistical illusion. Following such a system would lead to losses, the cost of tickets, over time, just as technical analysis leads to losses due to transaction costs.
Chapter 7: How good is fundamental analysis? Examines the effectiveness of fundamental analysis, particularly the ability of security analysts to forecast corporate earnings. It presents research indicating that analysts' earnings forecasts are often no better than simple extrapolations of past trends and are prone to significant errors. It highlights reasons for forecasting difficulties, random events, creative accounting procedures, and analysts themselves, incompetence, or pressure to generate business. It analyzes the performance of mutual funds as a proxy for professional investment management, concluding that the average mutual fund underperforms broad market indexes after expenses. It discusses survivorship bias in mutual fund data, where only successful funds are included, artificially inflating perceived performance. It introduces the semi-strong and strong forms of the random walk theory, which argue that publicly available information, semi-strong, and even inside information, strong, cannot be consistently exploited for abnormal returns. Keys takeaways. While fundamental analysis is theoretically sound, its practical application is severely hampered by the unpredictability of future events and the inherent difficulties in forecasting. The average professional money manager, including mutual funds, consistently underperforms a simple, unmanaged market index after fees and trading costs. The market is highly efficient in incorporating new information quickly, making it nearly impossible for investors to profit consistently from public announcements. Practical example: the expert stock tip. Your friend who works in finance tells you about a sure thing stock based on their company's internal analysis of the firm's earnings prospects. Even if the analysis is sound, by the time you hear about it, the market has likely already adjusted the stock's price to reflect that information. Trying to profit from such tips is like trying to catch a falling feather. By the time it reaches your hand, its downward motion has largely dissipated. This illustrates the semi-strong form of the random walk theory.
Chapter 8, A New Walking Shoe, Modern Portfolio Theory, introduces Modern Portfolio Theory MPT by Harry Markowitz, which revolutionized investment thinking by focusing on risk diversification. Defines investment risk as the dispersion of returns or variability of outcomes. Demonstrates how diversification can reduce risk by combining assets whose returns are not perfectly correlated. In the ideal case of negative correlation, risk can be completely eliminated. Explains that diversification in practice can significantly reduce unsystematic risk, company-specific risk, but cannot eliminate systematic risk, market risk, which is the tendency of all stocks to move together. Highlights the benefits of international diversification, as global economies are not perfectly correlated, further reducing portfolio risk. Key takeaways. Investors are generally risk-averse. They seek to maximize returns for a given level of risk or minimize risk for a given level of return. Diversification is the closest thing to a free lunch in investing. By combining different assets, investors can reduce overall portfolio risk without sacrificing expected returns. International diversification and investing in different asset classes, like real estate, offer additional risk reduction benefits due to lower correlations. Practical example: the weatherproof business portfolio. Imagine owning a business that sells umbrellas, does well in rain, and another that sells ice cream, does well in sun. Individually, each is risky due to weather variability. However, by owning both, your overall revenue is much more stable, as one offsets the other. This is precisely the principle of diversification in action. Chapter 9, Reaping Reward by Increasing Risk, introduces the Capital Asset Pricing Model, CAPM, which posits that higher average long-run returns are only achieved by assuming greater systematic risk. Explains beta as the measure of systematic risk, a stock's sensitivity to overall market movements. High beta stocks are aggressive, low beta stocks are defensive. Presents empirical evidence from Fama and French and Malkiel's own studies, suggesting that the relationship between beta and return is often flat or inconsistent, leading to questions about beta's usefulness as a sole risk measure. Discusses arbitrage pricing theory, APT, as an alternative, suggesting that multiple systematic risk factors, such as changes in national income, interest rates, and inflation, influence returns, not just market beta. Key takeaways. While diversification can reduce unsystematic risk, investors are only compensated for bearing systematic risk, market risk. The effectiveness of beta as a consistent predictor of higher returns for higher risk has been challenged by empirical studies. Risk is a complex, multifaceted concept that cannot be captured by a single measure, and new theories like APT suggest other economic factors play a role. Practical example: the high-stakes poker game. Imagine a poker game where you can choose a table based on its beta, how much it swings with the overall casino's success. CAPM would suggest that higher beta tables offer higher potential winnings. However, Malkiel's findings imply that the actual payouts from these tables don't consistently align with their beta. Some high beta tables might even underperform. This suggests that simply chasing high beta investments isn't a reliable path to greater rewards, and other factors are at play.
Chapter 10, The Assault on the Random Walk Theory. Is the market predictable after all? Addresses the perceived failings of the efficient market theory, particularly in light of significant market crashes, 1987, 1998, and the rise of behavioral finance. Examines predictable patterns or anomalies in stock prices. Momentum
Short-term price changes tend to persist. Reversals, stocks that perform poorly over several years tend to outperform later. Seasonal moodiness, effects like the January effect, small firm outperformance in January, and the weekend effect, negative returns from Friday to Monday. Investigates relationships between fundamental variables and future stock prices. Size effect, smaller stocks often outperform larger ones. Low PE multiples, stocks with low price earnings ratios tend to outperform. Low price to book value ratios, value stocks, low price book, tend to produce higher returns. High initial dividends and low PE predict higher subsequent returns. Critiques these anomalies, arguing they are often small, inconsistent, or unexploitable after transaction costs and may simply reflect risk premiums or data mining. Key takeaways. While some statistical anomalies and behavioral biases exist, they generally do not offer consistent, exploitable profit opportunities for individual investors after accounting for transaction costs. The market still exhibits a remarkable degree of efficiency in processing information, and any persistent mispricings are quickly corrected. Long-term investing, based on a broad market index, remains the most effective strategy. Practical example: the lucky coin flip strategy. Imagine you're told that if a coin lands on heads 3 times in a row, it's statistically more likely to land on heads again. You devise a complex system to bet on this predictable pattern. However, each flip is independent. While you might get lucky occasionally, in the long run, the small edge, if any, is eaten up by the cost of making bets. This is analogous to most market anomalies. They might appear statistically significant on paper, but are not consistently profitable in the real world due to transaction costs or their ephemeral nature.
Chapter 11. A Fitness Manual for Random Walkers. Emphasizes the importance of non-investment resources like medical and life insurance to provide staying power and avoid forced selling of investments. Stresses defining clear investment objectives, especially one's sleeping point, the level of risk one is comfortable with. Advises legally avoiding taxes through retirement plans, IRAs, Roth IRAs, Keogh plans, and tax-deferred annuities, as these offer significant long-term advantages. Recommends competitive yields on cash reserves through money market mutual funds, money market deposit accounts, and bank certificates to combat inflation. Suggests investing in bonds, zero coupon, mutual funds, tax-exempt, TIPS, for diversified income and inflation protection. Advocates for home ownership as a primary real estate investment due to tax advantages and forced savings. Recommends real estate investment trusts, or REITs, for diversified exposure to commercial real estate. Advises caution with gold and collectibles as investments, prioritizing them for enjoyment rather than expected returns. Emphasizes minimizing commission costs by using discount brokers or electronic trading. Stresses broad diversification across asset classes to reduce risk. Key takeaways. Financial planning goes beyond just picking stocks. It involves managing risk, taxes, and liquidity across all aspects of your financial life. Tax-advantaged retirement accounts are a powerful tool for long-term wealth accumulation due to tax deferral. Diversifying across various asset classes, stocks, bonds, real estate, and cash, is essential for managing overall portfolio risk. Practical example: building a financial safety net. Before even thinking about individual stocks, ensure you have an emergency fund in a high-yield money market account, adequate health and life insurance, and are maximizing contributions to your 401k or IRA. These foundational steps reduce the risk of needing to sell investments at an inopportune time and provide significant tax advantages that compound over decades.
Chapter 12. Handicapping the Financial Race, a primer in understanding and projecting returns from stocks and bonds. Explains that long-run stock returns are primarily driven by the initial dividend yield and the long-term growth rate of dividends or earnings. notes that short-term stock returns are also influenced by changes in valuation multiples, PE or price dividend. Clarifies that long-run bond returns are approximated by their yield to maturity at purchase, with short-term returns affected by interest rate changes. Analyzes 3 historical eras of financial market returns: the age of comfort, the age of angst, and the age of exuberance, showing how inflation and changes in valuation relationships impacted returns. Projects future returns for stocks and bonds in the age of the millennium, cautioning against expecting the extraordinary returns of the late 20th century. Key takeaways. Long-term stock returns are fundamentally linked to dividend yields and earnings growth, while bond returns are tied to initial yields. Changes in market sentiment and valuation multiples can significantly impact short-term returns. It's unrealistic to expect past high returns to continue indefinitely. Future returns will likely be more modest, particularly for broad market indexes. Practical example. Projecting your retirement nest egg. You're planning for retirement in 30 years. You can't just assume your investments will grow at the same rate they did during the recent bull market. Instead, you'd use a more realistic projection based on current dividend yields and conservative earnings growth expectations, as in Malkiel's 8% for the S&P 500. This provides a more grounded estimate for your financial planning.
Chapter 13, A Life Cycle Guide to Investing, emphasizes that investment strategy must be tailored to an individual's life stage, considering factors like age, earning ability, and financial responsibilities. It highlights 4 asset allocation principles. Risk and return are related. Investment risk decreases with longer holding periods. Dollar cost averaging can reduce the risk of market timing, and distinguish between risk attitude and risk capacity. It recommends an aggressive stock-heavy portfolio with international diversification for younger investors, 20s-30s. It suggests gradually shifting towards more conservative, income-producing assets, bonds, REITs, and others, as investors age and approach retirement. It proposes a rule of thumb: bond allocation should roughly equal one's age. Key takeaways. Asset allocation is the most critical investment decision, accounting for over 90% of an investor's total return. Younger investors have a higher capacity for risk due to longer time horizons and future earning potential, allowing them to take on more volatile, growth-oriented investments. As one ages, the focus should shift from aggressive growth to capital preservation and income generation. Practical example: the retirement savings timeline. A 25-year-old starting their career might put 80 to 90% of their retirement savings into a globally diversified stock index fund, accepting higher short-term volatility for greater long-term growth potential. A 60-year-old nearing retirement might only have 30 to 40% in stocks, with the rest in bonds and other income-producing assets, prioritizing capital preservation and stable income to cover living expenses. This is a direct application of the Life Cycle Guide.
Chapter 14, 3 Giant Steps Down Wall Street, outlines 3 practical strategies for investing in stocks. The no-brainer step, indexing, investing in broad market index funds, e.g. S&P 500, Wilshire 5000, for diversified, low-cost, and tax-efficient returns. The do-it-yourself step, stock picking, for those with a speculative temperament, offers 4 rules to tilt the odds in their favor while limiting risk. The substitute player step, actively managed funds, cautions against relying on past performance of active managers, emphasizing the importance of low expense ratios and avoiding funds with high unrealized capital gains. Recommends index funds as the most suitable strategy for most investors due to their superior long-term performance, low costs, and tax efficiency. It provides a Malkiel step for investing in closed-end funds at a discount, acknowledging that such opportunities are rare due to market efficiency. Stresses the importance of minimizing investment costs, loads, expense ratios, as they significantly erode long-term returns. Key takeaways. For the vast majority of investors, a passive indexing strategy is superior to trying to beat the market through stock picking or active fund management. Investment costs, fees, commissions, taxes are major drags on returns and should be minimized aggressively. While the allure of beating the market is strong, consistent outperformance is exceptionally rare and often attributable to luck rather than skill. Practical example: choosing your retirement savings vehicle. Instead of trying to pick the next Amazon or hiring a star mutual fund manager, simply invest your retirement savings in a low-cost total stock market index fund and a total bond market index fund, adjusting the allocation according to your age. This no-brainer approach is statistically proven to outperform the majority of actively managed strategies over the long term.
Main idea of the book, A Random Walk Down Wall Street, argues that short-term stock price movements are unpredictable and resemble a random walk. Malkiel critiques both technical analysis and fundamental analysis as unreliable for consistently outperforming the market, citing historical speculative bubbles and the poor long-term performance of actively managed funds. He champions the efficient market hypothesis, asserting that all publicly available information is quickly reflected in stock prices. The book ultimately advocates for a passive, diversified, long-term investment strategy using low-cost index funds as the most sensible and effective approach for individual investors to build wealth over time.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.